Thanks to Bellwether Advisors for making us a part of this insights sharing platform. At IDFC, we like to do a level 2 thinking and to think more into human behaviors and how they are associated with investments and better results. So we thought it was a great opportunity to share what we have learned here in last 8-9 years here. Okay, so let me give you a little background. How the edge which an investor has today is changing. Like if you looked 20 years back, if you had access to somebody in Mumbai who was a big stockbroker and who could give you an annual report first in Gurgaon or Delhi, you had an edge over other investors. So you could take a better decision because that information was not available to everyone. So that was called an information edge. That edge got shifted to something called a knowledge edge. So 10 years back when internet boom happened and the internet penetration happened and people started making websites, publishing blogs, writing their research, the websites like Value Research, Money Control, a lot of data was there already for you, pre-prepared. So the information edge vanished. Then you had something called a knowledge edge. So if you were ahead of the curve in technology, if you were the first on Twitter and you could read reports of bloggers and analysis, and you could have a knowledge edge. But last 2-3 years, even the knowledge edge is almost vanishing because it's accessible to everyone. So any idea what is the edge which you have today as an investor? What is the edge which any one of you as an investor can have today because you don't have information edge and knowledge edge to take decisions? Today you can only have a behavioral edge, which means a better behavior as an investor. And unfortunately, the behavior edge which you can have, you cannot have it from the internet, or you have to have it yourself. It is an experiential kind of a learning. So I will give you a few ideas on how you can have a behavioral edge. It'll also, this next 30-40 minutes interaction will also try to probe how our brain works, because that's how we take decisions, and it is more towards investments. And we had kept 2 tools in front of you when you had arrived. They were also something to do with how our brain works in a very linear function, and it's very difficult to take it away from that linear way it is used to. So I'll start with a little video on how we brain understands things and how it is so difficult to reverse it, and unlearn something.
Hey, it's me, Destin. Welcome back to Smarter Every Day. You've heard people say it's just like riding a bike, meaning it's really easy and you can't forget how to do it, right? It's me, Destin. Welcome back to Smarter Every Day. You've heard people say it's just like riding a bike, meaning it's really easy and you can't forget how to do it, right? But I did something. I did something that damaged my mind. It happened on the streets of Amsterdam, and I got really scared, honestly. I can't ride a bike like you can anymore. Before I show you the video of what happened, I need to tell you the backstory. Like many 6-year-olds with a MacGyver mullet, I learned how to ride a bike when I was really young. I had learned a life skill and I was really proud of it. Everything changed though when my friend Barney called me 25 years later. Where I work, the welders are geniuses and they like to play jokes on the engineers. He had a challenge for me. He had built a special bicycle and he wanted me to try to ride it. He had only changed one thing. When you turn the handlebar to the left, the wheel goes to the right. When you turn it to the right, the wheel goes to the left. I thought this would be easy, so I hopped on the bike ready to demonstrate how quickly I could conquer this.
And here he is, ladies and gentlemen, Mr. Destin Sandlin. First attempt riding the bicycle.
All right. So the faster I go, the better.
Yeah.
I couldn't do it. You can see that I'm laughing, but I'm actually really frustrated. In this moment, I had a really deep revelation. My thinking was in a rut. This bike revealed a very deep truth to me. I had the knowledge of how to operate the bike, but I did not have the understanding. Therefore, knowledge is not understanding. Look, I know what you're probably thinking. Destin's probably just an uncoordinated engineer and can't do it. But that's not the case at all. The algorithm that's associated with riding a bike in your brain is just that complicated. Think about it. Downwards force on the pedals, leaning your whole body, pulling and pushing the handlebars, gyroscopic precession in the wheels, every single force is part of this algorithm. And if you change any one part, it affects the entire control system. I do not make definitive statements that often, but I'm telling you right now, you cannot ride this bicycle. You might think you can, but you can't. I know this because I'm often asked to speak at universities and conferences, and I take the bike with me. It's always the same. People think they're going to try some trick or they're just going to power through it. It doesn't work. Your brain cannot handle this. For instance, this guy, I offered him $200 just to ride this bike 10 feet across the stage. Everybody thought he could do it.
No, you didn't understand. You didn't understand. So, this way. Okay. All right, a second. All right, so, whenever you're ready. Yeah. Wait. No, you have to keep your feet on. All right, here we go. Wait. Like, you gotta start rolling at least. And go. Oh, go! All right, back up. Okay, wait. Keep your feet on the pedal. Go. Go right on. Just keep your feet on the pedals. Hands on. Yeah, come on. All right, one more time. Okay.
Once you have a rigid way of thinking in your head, sometimes you cannot change that, even if you want to. So here's what I did. It was a personal challenge. I stayed out here in this driveway and I practiced about 5 minutes every day. My neighbors made fun of me. I had many wrecks, but after 8 months, this happened. One day I couldn't ride the bike and the next day I could. It was like I could feel some kind of pathway in my brain that was now unlocked. It was really weird though. It's like there's this trail in my brain, but if I wasn't paying close enough attention to it, my brain would easily lose that neural path and jump back onto the old road it was more familiar with. Any small distractions at all, like a cell phone ringing in my pocket, would instantly throw my brain back to the old control algorithm and I would wreck, but at least I could ride it. My son is the closest person to me genetically, and he's been riding a normal bike for 3 years. That's over half his life. I wanted to know how long it would take him to learn how to ride a backwards bike, so I told him if he learned how to ride a backwards bike, he could go with me to Australia and meet a real astronaut. Are you going to give up?
No.
Go ahead. This is how it starts. Look at this. This is such a big deal. Get up, you got it. Did you see his brain get it? So he, in, how many weeks have we been doing this? 2 weeks? In 2 weeks, he did something that took me 8 months to do, which demonstrates that a child has more neuroplasticity, am I even saying that right, than an adult. It's clear from this experiment that children have a much more plastic brain than adults. That's why the best time to learn a language is when you're a young child. All right, today's bike log. I can ride smooth, I can ride fast. I'm thinking the experiment is over. Okay, now I'm in Amsterdam, a city that has more bicycles than people. The question is, can I ride a normal bike now? I mean, I've spent all this time unlearning how to ride a bike. If I go back and try to ride a normal one, will my brain mess up? So I've tweeted a Smarter Everyday meetup, if you will, and I'm going to see if somebody brings a bicycle, and I'm going to try to ride a normal bike.
It's backwards. It's backwards.
This was one of the most frustrating moments of my life. I had ridden a normal bike since I was 6, but in this moment I couldn't do it anymore. I had set out to prove that I could free my brain from a cognitive bias. But at this point, I'm pretty sure that all I proved is that I could only redesignate that bias.
So what you're not seeing is just a group of people here looking at me, looking at the strange American that can't ride a bike because they think I'm dumb. But I'm actually 2 levels deep into this because I've learned and unlearned. All right.
After 20 minutes of making a fool out of myself, suddenly my brain clicked back into the old algorithm. I can't explain it, but it happened in a very specific moment.
Got it. I'm back. Oh, it clicked. Hold on, it clicked. I got it. Okay, there it is. There's the moment. Okay, I can ride a bike.
I tried to explain this to the people around me, and they just didn't get it. They thought I was faking the previous 20 minutes, and I couldn't get anybody to believe me.
That looked like I faked that, didn't it?
Yeah.
Just a fake. You think I'm faking. You don't believe me.
That looks so weird. You were like, la la la, and it's full.
You think I'm lying, don't you?
I do.
I'm not lying.
I felt like the only person on the planet who had ever unlearned how to ride a bike, and I couldn't articulate it to anyone because everybody just knew that you can't forget how to ride a bike. So I learned 3 things from this experiment. I learned that welders are often smarter than engineers. I learned that knowledge does not equal understanding. And I learned that truth is truth, no matter what I think about it. So be very careful how you interpret things, because you're looking at the world with a bias, whether you think you are or not. I'm Destin. You're getting smarter every day. Have a good one.
Okay, if you want to support Smarter Every Day, you can download a free audiobook at audible.com/smarter. I recommend Command.
So it showed you that how most of us look everything with a bias, with our own way of thinking, and that is based on our personal experiences in the life, how we have seen things, how we have seen our peers, but that is again we are seeing things with a bias. This is more true for investments. So we'll move ahead a bit, and I'll share some biases which we carry and how they impact our decision making. So we, day in, day out, keep fighting with the brain to take decisions. I'll tell you how our brain is composed and how our various ways, how we looked at human brain and how it takes decisions. Yeah, so human brain is largely composed of 2 parts. You would have read it at many places, the left brain and the right brain. The left brain is more analytical, mathematical, and the right brain is more creative, innovative. And there is always an imbalance. So if you are an artist, you have a heavy right brain, and if you are an economist, most probably you have a heavier left brain. But the challenge is we can use the part which is less dominant. For example, I can give you my example. I come out with more stories and innovation and creative ideas, but I'm not too great at analyzing graphs and charts. So if I can make this part work a bit higher, my decision making will improve. So this is for everyone. Whichever part is little lower, if you can stretch it a bit, and I'll tell you how to do it. And this exercise also involved stretching your left brain, which we put it. This is Professor Daniel Kahneman, Nobel Prize winner in Behavioral Finance. He's shared that human brain has 2 parts. One is system 1 and one is the system 2. System 1 is an automatic brain, the immediate response, and system 2 is a thinking brain. For example, if I were to ask you what is 3 multiplied by 3, the answer 9 will come immediately, because we practiced it so many times in our life that it is automatically stored there. But if I were to ask you what is 13 multiplied by 69, the answer probably will not come through fast, because this whole thing has gone into system 2, which is the thinking and the slow brain. And it is a lazy brain. It does not like to work. That is how we got it from genetics. So, but 3 multiplied by 3 is very automatic for us. But I see my 5-year-old who is in class 1. For her, 3 multiplied by 3 is equal to 9 is a very big struggle. She has to repeat it 20 times, and she forgets it 3 days later again. So we've all gone through that, because for her it is a system 2 activity. It is not instant and automatic. Okay, so I've given you what is system 1 and system 2. So this is a system 2 activity. You can all read this. One day, father, doctor and son were traveling in their car, and they met with an accident, and both got injured. Both were taken to a nearby hospital, and both had to be operated. First, the son was taken to the operation theater, and the doctor operated his son successfully. So what is unique about this story? It's a system 1, system 2 exercise. Anybody can share, because try to make it a bit interactive. Yes, who said that? Doctor's mother is a level 2 thinking in the system 2 thinking. Can you just pass it on? Sure. This is a small gift from our side. Thank you very much. I did not get it when I went through it. Normally we have a perception or a stereotype that a surgeon is always a man. here the mother is a surgeon, so she has operated her son. This is system 2 thinking. This is higher level thinking. This is evolved thinking. That's what we try and do at IDFC as well. Okay, so this is Carl Richards. He's authored a book called Behavior Gap. So what he says is that, I'm not using a pointer, so if this is the market return, this is what the investors have got. So in Indian context, the market return is 17% per annum for last 35 years. Investors have got about 6-7% per annum in their portfolios. So what you have not got, the gap of 10%, is the behavior gap. That is because our biases are not so correct decision making. And this is expected to continue because very few investors will migrate to better behaviors. So your portfolio return, very few investors I have met in last 12 years who have actually compounded their wealth at 10% plus over last 12 years. Yes, sure. You're very right. Absolutely right. Absolutely right. Absolutely right. So he's shared a very good insight that we at investors at large cannot become experts of this field because we are doing a different profession. So there is where the role of an advisor comes in, and if you have a great advisor who has gone through cycles, he can help you, bridge these gaps. Yes, perfect, absolutely. Another learning which I have is that your advisor also gets impacted by your own thinking. So if you can evolve your own thinking and ask better questions, second stage questions, the process for him becomes easier. But I understand that the initial stage of your investing career, more work has to be done by advisor in getting this. Okay, now what are biases? And we carry about 30-40 biases. There's a book called Art of Thinking Clearly. We've picked this from there. So we'll cover 3-4 biases, and if they are helpful. Okay, this is action bias. Ankush, you can press W, I'll just say W. So this first is the action bias. This is a major destroyer of the wealth management process in client portfolios. Action bias, I'll give you a story and then how it is related to investments. So there was an analysis of a penalty shootout of World Cup football final matches. So they said, देखते हैं कि जो मारने वाला है, shooter वो किधर मारता है, and then they said, let's see how the goalkeeper reacts. So they did a mathematical analysis of it, and they realized in the final of the matches, जो मारने वाला है, shoot करने वाला है, he is hitting 1/3 on all three sides, in the center, in the left, and in the right. Right? So this was the mathematical analysis. So then they went to the goalkeepers, one of the teams. They said, आपको 1/3 बीच में आएगा, 1/3 left में आएगा, 1/3 right में आएगा. And the research also showed that 1/3 of the goals were not saved. Lesser than that was saved. So they said, even if as a goalkeeper I keep standing in the middle, I don't do anything, I'll be able to save 1/3, right? So even after this feedback was shared, the goalkeeper would eventually jump to the left or the right after having this data, and he could not still stay 1/3. So this is how we are built in our brain, action bias. We like to act. So most of the investors ask for monthly statements of their portfolios. That will subject you to action bias. They will subject your advisor to action bias. Because if you have invested in 3 funds, one would have not done well. एक ने अच्छा नहीं किया होगा, and your first call to your advisor will be, मैंने 3 funds में डाला, पहले में 12% है, दूसरे में 10 है, तीसरे में 8 है, इसको हटाओ. Okay, so I advise clients, if you want to control this action bias, can you ask for statements once a year? 30% agree. Because this whole process of wealth creation is a decade process, it's not a monthly process. And we are in markets which are up and down, so 1 month later you would be anywhere. So I would request if you can force yourselves to go on an annual portfolio statement format instead of a monthly portfolio statement, because उससे फिर control होगा नहीं. And the stock market and the ticker and the CNBC and the Economic Times is all a damager to your process of wealth creation, because it will force you to act like a goalkeeper. Yeah, can move on. Okay, this is our next bias called loss aversion bias, loss aversion theory. So you invested 10 lakhs. This became 15 lakhs. So you made 5 lakhs. This is the happiness quotient which you got. And you invested 10 lakhs in another fund, that became 5 lakhs. So the pain of losing 5 lakhs is 5 times of the happiness which you got by 5 lakhs. So you invested in two funds, 10 lakhs each. First became 15 lakhs, the next second became 5 lakhs. तो अब 5 लाख रुपए की जरूरत है, तो कहाँ से आना चाहिए बाहर? Which one should be punished? So the two investments, 10 lakhs each. First became 15 lakhs, second became 5 lakhs. Yes, 90% investors punish the fund which is not, which has become 10 lakhs to 5 lakhs, because the pain is so much, you cannot mentally handle it. So you say, ये fund को पहले हटाओ, ये अच्छा नहीं है. And every fund manager goes through a cycle. I'll show you how the best of the fund managers in the world, they go through very big cycles. Okay, so you are not sad after losing, so you are very, very sad. So it wanted to depict how this loss aversion bias works in our brains. This is another bias, this beautiful bias, and if I had a choice to put one bias out of my life, it will be overconfidence bias. So overconfidence bias क्या बोलता है कि when I am presenting to you as a zonal head at IDFC Mutual Fund, I get a feeling which is artificial that I am one of the best zonal heads in the fund house industry. And similarly, the guys from other fund houses also get. When Brijesh and Ashish talk to you, they get the feeling that they are the best advisors in the city. When you talk to them, each one of you gets a feeling that you are the best, most aware investor in the city. You know it all. So this feeling has advantage and a disadvantage. I'll tell you both. The advantage of this feeling is that if I get a feeling that I am one of the best fund guys in Delhi, then it gives me confidence to talk to you. It gives me that boost to talk to you. But the pitfall of this overconfidence bias is it reduces my humbleness, humility. And I become blind to things which other fund houses might be doing better than me. So if you start feeling, all of you, that you are the best investor in this room, then you will probably be a bit blind to how others are thinking better than you, right? So we had done an experiment with advisors. I'll give you a story about overconfidence bias. So we put a simple two questions. We said, आपके पास retirement में, whenever you quit working, how much investable surplus or the mutual fund portfolio will you have? Question number 1. I'm not doing this experiment with you, I'm directly telling you the story. And question number 2 was, how much people will have average in this room? How much I will have investable surplus when I quit working at say 50, and how much people will have in this room when they quit working? So the answer was, I will have 5 crores when I quit working in mutual fund portfolio, and the average of the room was 2 crores. And this was given by everyone. 90% of the people in the room. This cannot be true. ऐसा हो नहीं सकता है कि average room की 2 crore और सबके पास 5 crore. This is mathematically not correct. So we always feel we are better equipped. If you can reduce this a bit, this is very helpful in making investment decisions. Okay, this is another bias called recency bias. Recency bias is what happens in last 1 year tends to drive my decision making. 3 साल पहले मैं आपसे इस रूम में मिलता तो सब लोग मुझे रियल एस्टेट की स्टोरी बताते, बट लास्ट 2 ईयर से स्लो डाउन है, तो वी विल टॉक मोर ऑफ थिंग्स अदर देन रियल एस्टेट बिकॉज इट्स स्लो डाउन. सो इवन इफ द लास्ट 3-year return is 15%, my decisions are more governed by what has happened in last 6 months or last 1 year. So I'm more impacted by that. I'll give you another story. This is a scene from a bomb blast in Lajpat Nagar market in Delhi a few years back. So if I were to ask you which is a safer date to visit this place, 3 days after the blast or 3 years after the blast? 3 days after the blast, right, you're right. But when we go there 3 days after the blast in that market, we probably go like this from there and not even looking at the side, though it's risk-free that time, probability-wise, out of both the options, right? So recency plays very big. Yes, perfect. So if you're driving very fast on National Highway 8 towards Gurgaon in the morning, and if you see a big accident, the 80 speed goes to about 50, and then after 5 minutes it goes to 80 again. Right? So yeah, so from 100 you go to 50 and then back after 5 minutes. So that is how recency bias plays on our brains. So recency bias is also true for investments. You know, you look at last 1 year return and take a decision and then realize that you've not got anywhere of 1 year later. This is another bias called confirmation bias. So confirmation bias क्या बोलता है कि when I take a decision, I look for cues from the environment to support that the decision is right. Let me give you an example. For example, if I want to buy an Innova car, the buying process is typically I'll talk to my friends who have that. I'll try to reach out to somebody who's driving it, read reviews on the internet, and compare it with other vehicles, new launches, and then take a decision that, okay, I'll buy Innova. So, for example, the time gap of taking the decision that I'll buy Innova to taking the delivery is 15 days. Let's assume that. So, in those 15 days when I am on the road, I only see Innovas on the road. Is that right? So, when you decide something, for example, you have two choices, to book an apartment in Sona Road or Golf Course Road. If you've decided on Golf Course Road, you will get this supported from the environment that that's a better place. Right? That's how confirmation bias works in. So, so if any of you were to ask me, then how do you control it? If all of us know that there is a confirmation bias, so you can manage this bias by experiencing disconfirmation bias. So, for example, I'll give you an example. The American Express team called me. I use their one credit card. So I am also a learner of biases 2 years back, and I got big time into reading about behavioral bias, and I have started practicing how I can make better decisions. So I'll give you my own example. So they called me that आपके पास you have one card, we want to give you another card, and they told me 5 different reasons why I should take that another card. So my first reaction of a normal human brain was to buy it because I am very happy customer from them. But then the antidote of this confirmation came to my mind. I told them that कल आप मुझे फिर से phone करिएगा. I want to know 5 reasons why I should not buy this card. If you give me truthfully those 5 reasons why I should not buy this card, I will probably be able to take a better decision. So next day they called me that आपको American Express card नहीं लेना चाहिए because you are not a golf player. This card has more features linked with the golf players. You should not buy this card because HSBC card has better reward program in the same category. But still I went for the that card after knowing that. But that was, I think, a little better effort. If you can all do that in your own decision making, it will help you. Because the more time we take to take the decision, the more rigid it is in the brain. If you take 1 year to take a decision, it's very difficult to practice disconfirmation. Yeah, go on. Okay, another video for you.
How many passes does the team in white make? The answer is 13. But did you see the moonwalking bear?
Here are a few concepts. This is the last part of my brief presentation. A few concepts which are important keeping in mind, and we'll be happy to share this in case you would want through Bellwether. Okay, so these 2 movies which came in, any of you saw any of this one movie or both movies? Hera Fairy in 2000 and Ugly in 2014. You saw Hera Fairy, okay, great. So you remember the theme in the movie? Yes, who said that? Kidnapping, yeah. So both the movies there was a kidnapping. And जो kidnappers थे उन्होंने 2000 में they asked for 10 lakhs of फिरौती, and in 2014 they asked for 15 lakhs of फिरौती at 12% compounding. So that's inflation for you. They understand it better than us. The normal inflation is 7 to 8%, but the inflation which hits you in people sitting in the room is above 12% because our lifestyle is above middle class. So our portfolio should function. This is I wanted to share you how you have to keep inflation in mind. Yeah. So we also feel that it's better to be roughly right than precisely right and precisely wrong. So we feel that the question which is normally asked to advisors in mutual fund industry, market kya lagta hai, is itself a wrong question because it's very difficult to predict markets. So that question should be totally discarded from our discussions because it's very difficult to predict and even very difficult to get it right. This is about human behavior. So when the asset class starts rising, there is where the greed comes in. So last 70% of the transactions in any asset class in the bull run come in the last 30% of the time. So if the real estate has gone through a bull run from 2000 to 2012, 70% of people have booked apartments from 2009 to 2012. In my office I see around, including me, I have fallen prey to this and I have booked my apartment between 2009 to 2012 at the end of the run of the asset class. This is also true for equity markets, by the way. So we get much more inflows when market goes through a bull run, or when we have a 1 year return of 100% in the past. The flows much more higher in the markets. And then, can you go back? Yeah. So investors generally come in here 70%. You may not be in that 70%. And then time correction happens in every asset class, and then they go through the bit of pain for next 4-5 years, and then they exit. This what? Yeah, it's totally wrong. You have to become hungry here, and you have to kind of rebalance here. So it's very difficult to do it because there's another bias called social proof. Social proof says in 2012, if you would go to your club in the evening or a meeting like this, when you're outside after the meeting, in 2012 the only discussion is कि कौन सा flat book करना है. When you are 1 out of 10 and 9 discussing that, next day you go and call your broker कि मुझे बताओ कौन सा करना है. It's very difficult to overcome. This journey of investment success is of a loner. You have to be alone and you have to watch what people are doing, so you have to go reverse of that. Very difficult to practice. Yeah, so we made something which can help you to decide how this has become quite successful tool. Little technical, but I'll try to make it simple. So in last 15 years, market has remained in 3 zones: the green zone, the yellow zone, and the red zone. So 38% of the time, market has remained in the red zone, which is 19 and above price to earning. If you want, I'll explain a bit on price to earning, how it is calculated. And 16 to 19, 32% of the time, and 30% of the time in the green zone, which is less than 16 PE in last 15 years. Can you go to the next slide? The returns next. Yeah. So if you were an investor in the red zone, in next 3 years you got a 3% return from the market average. If you were an investor in the yellow zone, and you would have got a 20% return in the market. If you are an investor in the green zone, you would have got 32% from the market. Now go back. Go back. Yeah. So in last 15 years, 70% of the money has come in the red zone. 28% has come in the yellow zone, and only 2% has come in the green zone when real money is to be made. Because in the green zone, the news is very bad. The environment is very bad around. If you invite 100 investors in the green zone for a meet, you only probably get 20. But in the red zone, if you invite 100 investors, you might have 150. Because the environment is very good in the red zone. So in last 1.5 years, when we have been in the red zone, at IDFC, we've closed our flagship Premier Equity Fund for lump sum flows. We restricted lump sum investments in equity and advised more of systematic transfers of minimum 1 year. So we are trying to practice it the hard way, but that comes at foregoing some net profit, which we are fine with because it gives a better investor experience. So we have 1.5 lakh crore of lump sum inflow which has come in the last 1.5 years in the markets, which is a record high. You would have read it in the papers. So we are more happy investing here, all of us. This is global, this is not only Indian context. So if you can take decisions to invest here, you'll be much more happier. But it's difficult to do it. Yeah. Next. Yeah. Any idea what comes to your mind here? Time value of money, right? But we say that's not important. What is more important is value money of time, which very few people understand. Let me share you what that means. So this is the formula of compound interest, and we learned it in class 9th, 10th. This is the rate of return, and this is the time. So all our focus in taking decisions is on returns. कि return कितना आएगा, right? And that's not helping because investors, as I shared with you, are still making 7% per annum in markets because of the behavior gap. T is more important. This is what investors ignore. Any idea why T is more important than return? Return 8 आया 10 आया doesn't matter. I'll show you also in the next few slides. Return 8 आया 10 आया फर्क नहीं पड़ता. अगर time लंबा कर दिया तो बहुत फर्क पड़ता है. Any insight in this formula why T is more important than R? It is exponential. It is not multiplication. It's geometrically exponential. That's why it has a much bigger impact than 8 आया 10 आया. Okay, so this is one fund. Is it visible? The numbers are visible at the last? Okay. So this is 16-year performance. This is the fund performance year 1. Market is 80%, fund is 21%. And second year market is 3%. So third year 18% and fund is 8%. 16 years of underperformance in this fund. Will you invest in this fund? You know the market return and the return which the fund is giving. Yeah, this is the market return and this is the fund return every year. Very difficult to invest in this kind of a fund. This is the world's best fund, by the way. It is Berkshire Hathaway Warren Buffett's fund. It has delivered in 48 years 21% compounding against 9% in the market. The 16 years which I showed you are out of those 48 years of not so good years for him. But 1/3 of the time, the best investor in the world has failed. But do we have the patience to go through those cycles when Warren Buffett's fund, the best fund, one of the best funds in the world, is going through a 4-year zero return or a negative return? Okay, I'll repeat his question. He said, as a layman investor, how much time frame I should have when? So index, yeah, index system I shared with you, the red, yellow, green. If you can be a little bold and strong and take bigger decisions in the green zone, the probability is in your favor of making a return. That is one step. If you want to come in the red zone because you feel that it's easier when everyone is investing, news is good, newspapers are talking good language, CNBC is good, then it is a process of decades, not years. In the red zone, you can't come in for 3 years or 5 years and expect markets to do great. Fund managers can still do better. This is Sensex, but this is a thermometer. You know, fund managers may have a totally different portfolio than Sensex and still keep doing better. You know, so.
But in this case, if you keep tracking on your CAGR.
Yeah, so I would say minimum. The real, truthful, genuine answer is 10 years. Below that, equity could be difficult to handle. Normally, actually, yeah. So then you're passing it on to the next generation. I know of Jain families in Varanasi. I go to UP also. They are planning for 150 years. So that planning is going for next 3 to 4 generations. So. And with this, all this, the way we are growing social media and all that, our patience levels are dropping day by day in everything, not only in investments. So this side of the cycle, you have to really exercise your brain very, very large extent to make it very long. It is a decades process. I'll show you how compounding works. Yeah. So this is the master. How long master holds his investments? Washington Post, he's holding for 36 years. Jico 37 years. Coca-Cola. 26 years. Average holding from 97 to 2009 is 20 years. That's how he's able to build his wealth. Any idea how much is Warren Buffett worth? It's 100 billion, 30 billion he has donated, 70 billion he has. He's 86-year-old. He had his first billion at the age of 65. Started investing at the age of 11. 11 to 65, 1 billion. 65 years to 87, next 99 billion. So this plays out only 20 years later. I'll give you a very simple example from my own simple middle class professional example. I've been working for 17 years. 8 years back, I joined IDFC from ICICI Bank. 4 of us quit together that year. It was a slowdown year. It was a good time to change job. Markets were going down and job market was going down. So this opportunity came in. 3 of them withdrew the Provident Fund. And I somehow, I don't know, I needed money, but I continued. Maybe I didn't want to fill forms or something like that. So I checked up my Provident Fund balance. It was 30 lakhs now. Right now, if you calculate at 10%, actually is 8.75. Let's calculate 10 for understanding purpose. So 3 lakhs is interest per annum, which means 25,000 rupees mahina, 25,000 rupees per month. 25,000 rupees is my monthly contribution, employee and employer. So by sustaining my job, I am contributing 50,000 a month in my Provident Fund, which means 6 lakhs a year. 3 years is 18 lakhs. So the journey from 30 lakhs to 50 lakhs is going to be next 3 years. But the journey to reach 30 lakhs took 17 years. And from 50 to 75, 5 lakhs will be even faster if I go on. So compounding actually kicks in only after 15 years. I'll show you how. So this is power of compounding. I was reading somewhere on the Twitter, human brain is not wired to understand power of compounding. That's why nobody can do it. We are not wired. So I have tried. This is my own effort in the Excel sheet. I don't know I'll be successful or not. Okay, so this is year 2015. You are at 8% or 12%, Ankush? 8%. So you are keeping a very modest 8% return expectations with behavior gap, which I showed you because achieving 17% is still an uphill task. So you invested 10 lakh rupees and left it. You said नवनीत आया था, उसने बताया था 20 साल के लिए लगाना छोड़ देते हैं, नहीं करेंगे, ना statement मांगेंगे ना देखेंगे. So this is the simple interest, 10 lakh 80,000. This is compound interest. This is a new ratio for you. This is called multiplier, which is compound interest divided by simple interest. So, you keep going, and then after 10 years, you realize that the guy who was on the simple interest got 18 lakhs, and you were smarter. You were compounding your money, and you got 21 lakhs. Your multiple was 1.2 times. You can note down this number, 1.2 times. If you went on, the guy on the first side on the simple interest was at 26 lakhs, and then you reached 46 lakhs, which was a multiplier of 1.79 times. So 20 years, 8% multiplies 1.79 times. 30 years, investor number 1 was 34 lakhs in the savings account, simple interest. Compounding guy was at 1 crore, about 3 times. Let's say you went over your biases, you controlled them. From 8%, you actually got 12% compounding. This is a 12% sheet. So the multiplier, which was after 20 years 1.79 times, has gone to 2.854 times. So 34 lakhs ki jagah you have 96 lakhs. If you go on for 30 years, the multiplier is 6.5 times. So 46 lakhs and 3 crores. It's a big difference. But the important thing to remember is in this 30-year journey, out of this 3 crores, 2 crores has come in last 10 years. Most of the investors cannot cross this phase, which I shared with you, the Provident Fund example. If you get cross 20 years, the power of compounding kicks in only then. So if I am an advisor number 1, I generated 8%, and if Bellwether is advisor number 2, he generated 12%, and you were in the fund for 5 years, it doesn't matter much for your status to change. Your wealth status, wealth effect remains almost the same. You might analyze Excel sheets that जिस fund ने अच्छा किया उसने बुरा किया है, but you are there 1.2 times multiple. For the multiple to come in, it is only, and very few people can understand. I never leave even 1 day of compounding in my portfolio.
This purely says that you should start investing as early as possible.
Yes, absolutely. But the
But the flip side of it is, if you look at the Indian economy and the salary, it has actually grown in the last 10 years.
yes, I was coming to there. The practical situation is we get wealth.
Stay for the next 30
Agreed. But you have to, this is, equity investing is for next generation, not for us. So, it's theoretical to start investing at 25 because at 25 my salary was 5,000 rupees. I couldn't survive in Delhi coming from a small town. So, actual wealth you get only at when you're 40. Finish in 5 minutes, last 5 minutes. Do you want more? Should I close it here? Little more? Okay. Okay, so this is again another concept. We'll take last 5 minutes. Sorry for extending. The mean reversion. Okay, so this is like a pendulum. If your return is 100% last 1 year, the pendulum will swing to the other side to make it 15% average for last 10 years. If you are at minus 50% last 3 years return, I think it's a great time to invest because the pendulum will go on the other side. Yeah, go on. Okay, last concept, how investors have behaved in last 15 years. 2000 to 2004, we have analyzed the best equity, best asset class. D is for debt, G is for gold, and E is for equity. So debt was giving a 14% return in 2000-2004. The Excel sheet in 2004 was showing 14%. Investors came into this category, invested all their money here. Then 2005 to 7 bull run came in. All the investors came in equity, which was showing 45% CAGR for last 3-4 years. And when all the money came in here, equity gave you a minus return from 8 to 12. Gold gave the highest return. All the investors came in here. The gold is here. 2013 to 15, equity is number 1. All the money is coming here. We'll show you the chart 3 years later. We are not predicting anything, by the way. This is asset allocation that you should consult your advisor. You should be invested in all asset classes to get a superior compounding return.